Trump's impact, dollar's power, weakening, silver and gold, soaring one policy statement, just one sentence from the highest office. And suddenly, the dollar isn't what it used to be. Silver surged nearly 6% in hours. Gold punched through $3,000 like it was nothing. And the question every serious person should be asking isn't if, it's how fast. Because when a president demands the lowest interest rates in the world, when central banks start moving in formation, when the mechanics of currency devaluation shift from theory to active policy, there's a narrow window, a moment when the market is still pricing in the old rules. While the new reality is already unfolding, most will see it too late. But there's one threshold, one level that changes everything. Welcome to Financial Crisis Explained. If you've been through enough cycles to know that markets don't ring bells at the top or bottom, then you understand why this channel exists. We don't speculate, we analyze. And right now what's unfolding deserves your full attention. Do me a favor. If this kind of clear-headed economic analysis matters to you, subscribe to this channel. No fluff, no hype. Just the framework you need to think clearly when everyone else is reacting emotionally. And tell me, where are you watching this from today? Drop your country or city in the comments. Let's see how global this audience really is. Now, let's break down exactly what just happened. The date was February 10th, 2025. While most analysts were parsing employment data and inflation prints, a different kind of signal cut through the noise. Not from the Federal Reserve, not from Treasury officials, but from the Oval Office itself. We should have the lowest interest rates in the world. 7 words. Delivered not as suggestion, but as expectation. And in those 7 words, the entire framework for dollar valuation began to crack. This wasn't campaign rhetoric. This was policy direction from a sitting president with both the political capital and the demonstrated willingness to reshape institutions to match his economic vision. And the market, despite its initial hesitation, began to understand what was actually being communicated. The response was immediate and visceral. Silver, which had been consolidating near $32, exploded higher. Within hours, it touched $33.80, a gain of nearly 6% that caught even seasoned traders off guard. Gold, after weeks of brutal correction that saw weak hands shaken out below $250, reclaimed $3,000 with conviction. Mining stocks surged across the board, and quietly, almost imperceptibly, institutional money began repositioning. But here's what separates informed analysis from market noise. This wasn't just another commodity spike. This was repricing. When a head of state explicitly calls for interest rate policy that would position the United States below every major developed economy, the implications cascade through every level of the financial system. Lower rates mean reduced return on dollar-denominated assets. Reduced returns trigger capital outflows. Capital outflows weaken currency. Weaker currency drives inflation, and inflation forces the exact monetary hedge that just moved 6% in a single session. The chain reaction is mechanical, predictable, historical. What's different this time is the explicit nature of the signal and the political framework behind it. Previous administrations hinted, they suggested, they applied pressure through back channels and carefully worded statements. This approach is fundamentally different. It's direct intervention rhetoric aimed at reshaping Federal Reserve independence, not through legislation, but through public expectation and political pressure. The dollar index, which measures the greenback against a basket of major currencies, had already shown weakness leading into this moment. Trading near 107 after failing to hold above 110, the technical structure was fragile. But fragility becomes crisis when policy direction confirms the trend rather than counters it. And that's exactly what happened. Because when the market hears lowest interest rates in the world from the executive branch, it doesn't hear stimulus, it hears devaluation. Intentional strategic devaluation designed to accomplish multiple objectives simultaneously. Reduce the real burden of $36 trillion in federal debt. Enhance export competitiveness, and inflate away fiscal imbalances through currency depreciation rather than spending discipline. The playbook isn't new. It's been executed before, 1933, 1971, 1985. Each instance followed a similar pattern. Political pressure on monetary policy, explicit or implicit desire for weaker currency, initial market skepticism, then acceleration. What makes this moment particularly significant is the confluence of factors that amplify the underlying trend. Global central banks are already diversifying away from dollar reserves at the fastest pace in decades. China and Russia have been systematically reducing treasury holdings while accumulating gold. The BRICS nations are actively developing alternative payment systems. And now, at precisely the moment when dollar dominance faces structural challenges, domestic policy is moving in a direction that validates rather than counters those challenges. This is why silver didn't just tick higher. It surged. This is why gold didn't just recover. It reclaimed a critical psychological level that transforms market sentiment. And this is why mining equities, which had been left for dead during the correction, suddenly found aggressive buyers. The market was pricing in a new reality. Not tomorrow's reality, not next year's possibility, but the reality that's already unfolding in real time, driven by policy direction that can't be walked back without significant political cost. And here's the critical insight that most observers are missing. The move in precious metals wasn't driven by fear. It was driven by arithmetic, by investors and institutions running the numbers on what lowest interest rates in the world actually means for currency valuation, for real returns, for portfolio construction in an environment where the traditional safe haven, the dollar itself, becomes the risk being hedged against. The signal has been sent. The market has responded. And what comes next isn't speculation, it's sequence. There's a pattern in history that repeats with mathematical precision. It starts quietly, a policy shift here, a statement there. Markets dismiss it as noise. Analysts call it temporary. And then, seemingly overnight, the entire monetary structure reprices, not gradually but violently. The Plaza Accord. 5 nations gathered in a New York hotel and agreed to deliberately weaken the dollar. Within 2 years, the currency lost 50% of its value against the yen and Deutschmark. Fortunes were made and destroyed. Entire investment theses became obsolete. And the world learned a critical lesson. When major powers decide currency realignment serves their interest, market forces become irrelevant. The Nixon shock. Gold convertibility ended on a Sunday evening announcement. By Monday morning, the entire Bretton Woods system, the monetary framework that had governed global finance for nearly 3 decades, was dead. What followed wasn't chaos, it was recalibration. And those who understood the mechanics early positioned themselves accordingly. Now, 2025. Different mechanism, same underlying mathematics. The current situation doesn't require international coordination or unilateral decree. It requires something simpler and more insidious. Sustained interest rate suppression in an environment of persistent inflation. Here's the equation that changes everything. Real interest rates equal nominal rates minus inflation. So when the Federal Reserve holds rates at 4% while inflation runs at 3%, the real return is 1%, barely positive. Hardly compelling for international capital seeking safety and yield. But when political pressure drives rates down to 2% while inflation remains at 3%, real rates turn negative. And negative real rates don't just reduce dollar attractiveness, they create mathematical certainty of purchasing power loss. This is where most analysis stops. It identifies the problem, but fails to trace the mechanism. Let's trace it. International investors holding dollar-denominated assets face a calculation. Japanese pension funds, Middle Eastern sovereign wealth, European insurance portfolios, Chinese reserve managers. They're not holding dollars out of sentiment. They're holding dollars because of return, liquidity, and reserve status. Remove one leg of that stool, return, and the entire structure becomes unstable. When U.S. Treasury yields fall below comparable sovereign debt while offering negative real returns, capital flows reverse. Not immediately, not dramatically, but persistently. Month after month, quarter after quarter. The Treasury market absorbs $2 trillion in new issuance annually. If even 10% of that faces reduced foreign demand, domestic buyers must step in. And domestic buyers, primarily the Federal Reserve through direct or indirect mechanisms, create new currency units to make those purchases. This is monetary expansion by another name. Currency creation without corresponding economic growth produces one inevitable outcome: devaluation. But here's where the analysis gets more precise. The dollar's strength isn't just about interest rate differentials. It's about the carry trade, the massive global strategy where investors borrow in low-yield currencies and invest in higher-yield assets. For years, Japanese yen and Swiss francs funded dollar-denominated investments because U.S. rates exceeded foreign rates by meaningful margins. Reverse that differential, and the carry trade unwinds. Estimates vary, but credible analysis suggests $15 to $20 trillion in cross-border positions depend on interest rate stability and dollar strength. A sustained shift in rate policy doesn't just reduce new inflows. It triggers position closures on existing exposure, hedge funds unwind, banks rebalance, algorithmic systems execute pre-programmed risk management protocols. The technical term is reflexivity. The practical reality is acceleration. As the dollar weakens, imported inflation rises. Rising inflation justifies lower real rates, which weakens the dollar further. The loop feeds itself. And in that environment, hard assets, particularly monetary metals with thousands of years of value preservation history, become the rational hedge. Gold doesn't generate yield. It doesn't pay dividends. It simply exists as the asset that can't be printed, can't be debased, and can't be defaulted upon. When currency confidence erodes, gold's lack of counterparty risk transforms from limitation to advantage. Silver carries the same monetary properties with an additional dimension: industrial demand. Electric vehicles require silver, solar panels require silver, electronics, medical devices, 5G infrastructure all require silver. And unlike gold, where above-ground stockpiles could supply decades of demand, silver gets consumed, used, permanently removed from the monetary supply in industrial applications. This creates a peculiar dynamic. As currency devaluation drives monetary demand for silver, industrial consumption continues regardless of price. The metal faces bidding pressure from two distinct, non-overlapping sources. And current prices, hovering near 33 Rs, reflect neither the monetary reset nor the supply deficit that's been building for 3 consecutive years. The repricing thesis isn't based on speculation. It's based on inventory data, production decline rates, and the mathematical reality that you cannot consume more of a finite resource than you produce indefinitely without price adjustment. But there's one more element that makes this moment unique. For the first time in modern history, the entity pushing for lower rates, the executive branch, has both the political capital and the demonstrated willingness to challenge institutional independence. The Federal Reserve's dual mandate of price stability and maximum employment faces a third unwritten mandate, political alignment. When those forces collide, when policy direction conflicts with traditional central banking orthodoxy, markets don't wait for resolution. They reprice immediately, and what looks impossible at the beginning of the trend becomes inevitable by the end. There's a lie the market tells itself every single day. It's a comfortable lie, a convenient one, the kind of lie that lets pension fund managers sleep at night and allows portfolio construction models to function without existential questioning. The lie is this: precious metals are always available at the right price. Open any trading terminal, type in the ticker, watch the bid and ask flash in real time. Silver at $33.12, gold at $3,000+, liquid, accessible, infinite, apparently, in supply. Click a button and the position appears in your account. Close it tomorrow if you change your mind. The system works, the system has always worked, until it doesn't. Because beneath the digital abstraction of paper markets lies a physical reality that operates under entirely different rules. And those rules are now colliding with monetary policy in ways that most market participants fundamentally misunderstand. Start with the most basic question: where does this metal actually come from? Gold production peaked globally around 2018 at roughly 3,500 metric tons annually. Since then, despite record prices and massive capital expenditure, production has declined. Not stagnated, declined. The easy deposits have been mined. The high-grade ore bodies are depleted. What remains requires deeper drilling, more complex metallurgy, and exponentially higher costs per ounce extracted. The average grade of gold ore processed today is approximately 1.5 grams per ton of rock. Think about that ratio. Extract 1 ton of material from the earth, crush it, process it with cyanide, separate the residue, to obtain 1.5 grams of gold. At that ratio, the margin between profitability and shutdown is razor thin, and when geopolitical risk, environmental regulation, and energy costs rise simultaneously, marginal mines become uneconomic rapidly. New discoveries aren't solving the problem. Major gold deposits, the kind that can produce for decades, are being found at the lowest rate in 70 years. The pipeline from discovery to production runs 7 to 10 years minimum, often longer when permitting and development challenges emerge. Which means the supply coming online in 2027 was decided in 2017, and the decisions made in 2017 were based on gold prices near $1,200, not $3,000. The lag between price signal and supply response creates a structural deficit that cannot be closed quickly, regardless of price. Markets assume elasticity. Reality delivers rigidity. Silver's situation is more acute. Roughly 70% of silver production comes as a byproduct of mining other metals: zinc, lead, copper, gold. This means silver supply isn't primarily responsive to silver prices. It's responsive to base metal economics. When copper mines slow production due to weak industrial demand, silver output falls regardless of silver's price trajectory. The metal can surge 50%, and if copper prices are weak, supply doesn't materially increase, but demand operates under different mechanics entirely. Industrial consumption of silver hit 540 million ounces in 2024. Solar panel manufacturing alone consumed 180 million ounces, triple the amount used a decade earlier. Electric vehicles, with their substantially higher silver content than internal combustion vehicles, are adding demand that didn't exist 5 years ago. The global push toward electrification and renewable energy isn't a temporary trend. It's infrastructure replacement on a civilization-wide scale. And this industrial demand forms a price floor that's completely independent of monetary considerations. Even if investment demand disappeared entirely, which it won't, industrial consumption would continue absorbing 70% of annual production. The metal gets used, incorporated into products, distributed globally in quantities too small to economically recover. Unlike gold, which sits in vaults and can theoretically return to the market, industrial silver is functionally destroyed. The deficit has been running for 3 consecutive years now, total consumption exceeding total production by 150 to 200 million ounces annually. That gap is being filled by above-ground inventories, exchange warehouses, government stockpiles, and secondary recovery. But those inventories are finite. COMEX silver stocks, the most transparent measure of immediately available physical metal, have declined from over 400 million ounces in 2021 to roughly 280 million ounces currently. At the current deficit rate, visible inventories could reach critically low levels within 18 months. And critically low doesn't mean zero. It means insufficient to maintain the illusion of infinite paper market liquidity. Here's where the mechanism becomes dangerous. The futures market trades in contracts representing 5,000 ounces of silver each. Total open interest frequently exceeds 150,000 contracts. That's 750 million ounces of paper claims. Against 280 million ounces of physical inventory, the leverage ratio is nearly 3.1. This works perfectly well in normal markets where most contracts settle financially rather than through physical delivery. But when currency confidence erodes, when investors specifically want the metal rather than the cash equivalent, when industrial users begin securing supply ahead of need because of delivery concerns, the mathematical absurdity becomes operational crisis. Gold faces similar dynamics at smaller scale. Central banks purchased over 1,000 metric tons in 2024, the second highest annual total in history. China, Russia, Turkey, India, Poland. Nations that understand monetary history and draw different conclusions than Western financial orthodoxy about dollar permanence. They're not buying gold certificates. They're taking physical delivery, moving it into national vaults, removing it from the liquid supply that supports paper market function. And Western institutional investors are beginning to follow that lead. Pension funds that held gold through ETFs are increasingly demanding allocated storage. Family offices are building physical positions. Sovereign wealth funds are diversifying away from purely financial assets into hard commodities with no counterparty risk. Each ton removed from the active trading supply tightens the coil. Each industrial ounce consumed reduces the buffer. Each futures contract opened against declining inventory increases systemic fragility. The current pricing structure assumes infinite elasticity. It assumes supply will always meet demand at some equilibrium price. It assumes the system's leverage can be maintained indefinitely without physical settlement stress. History suggests otherwise. When paper markets lose connection with physical reality, when the claims exceed the underlying asset by ratios that can't be reconciled, when policy forces and supply constraints converge, price doesn't adjust gradually. It gaps violently to the level where physical holders are actually willing to sell, and that level isn't anywhere near $33 silver or $3,000 gold. Every major monetary transition in history has offered the same cruel lesson. The informed positioned early, the cautious waited for confirmation, and by the time confirmation arrived, the opportunity had already moved from strategic to tactical, from accumulation to survival. Gold revalued from $20.67 to $35 per ounce overnight by executive order. Those who held physical metal saw 69% gains instantaneous. Those who waited for clarity found themselves locked out. Private gold ownership criminalized, convertibility ended, wealth transferred from citizens to the state through monetary decree. The gold window closed on a Sunday evening. Markets opened Monday with the entire Bretton Woods system dead. Gold went from $35 to $200 within 2 years, ultimately reaching $850 by 1980. A 24-fold increase. Those who understood monetary mechanics positioned before the announcement. Everyone else chased the move higher, buying at progressively worse prices as the trend accelerated. Central banks globally expanded balance sheets by trillions. Gold entered a secular bull market that took it from $800 to over $1,900 by 2011. But the entry point mattered enormously. Those who bought in 2008 and 2009 captured the bulk of the move. Those who waited until 2011 bought the top and endured a decade of drawdown. The pattern is consistent. Monetary crisis creates opportunity, but the opportunity is time-limited and front-loaded. Right now, in February 2025, the market is offering a similar window, not because of prediction, not because of certainty, but because of probability-weighted assessment based on observable policy direction, supply-demand mechanics, and historical precedent. The question isn't whether precious metals will reprice higher. The arithmetic makes that outcome highly probable given current trajectories. The question is whether positioning happens before or after the majority recognizes what's occurring. And recognition typically arrives too late. Here's the framework for thinking clearly about this moment. The dollar index sits near 107, down from 114 in October 2024, but still elevated by historical standards. However, the trajectory matters more than the level. if explicit policy direction pushes rates below comparable developed economies, DXY breaking below 100 becomes not just possible, but mechanically inevitable. Below 100, the psychological break triggers algorithmic selling, index rebalancing, and headline-driven momentum that feeds on itself. That's the first threshold, the one that changes sentiment from skepticism to acceptance. Gold, holding above $3,000, represents the second critical level. The metal spent weeks correcting from highs near $350, shaking out weak hands, resetting technical indicators, building a base. Reclaiming $3,000 with conviction transforms resistance into support. It tells institutional allocators that the correction is complete and the uptrend intact. It triggers systematic buying from trend-following funds, and it resets price expectations across the entire complex. Silver's threshold is different. It's ratio-based rather than absolute. The gold-to-silver ratio currently sits near 91.1. Historically, during monetary stress and metals bull markets, that ratio compresses toward 60.1 or lower. If gold holds $3,000 and the ratio compresses to even 70.1, silver exceeds $42. At 60.1, silver reaches $50. These aren't speculative targets. They're mathematical outcomes of historical mean reversion during similar monetary environments. But ratios and levels are abstractions. What matters is what they represent. A shift in how capital views risk, return, and preservation. When real interest rates remain negative, when currency devaluation becomes explicit policy rather than accidental consequence, when supply deficits persist across multiple years, the traditional portfolio construction model breaks down. A balanced portfolio typically holds 60% equities, 40% bonds. That framework assumes bonds provide safety and income. But bonds are denominated in currency. And if currency is being deliberately devalued while yields are suppressed below inflation, bonds don't preserve wealth. They guarantee its erosion. Precious metals have historically represented 0% to 2% of institutional portfolios. But that allocation was determined during eras of dollar strength, positive real yields, and central bank credibility. Those conditions no longer apply. If even a modest reallocation occurs, pension funds moving from 0% to 5% metals exposure, sovereign wealth diversifying 10% of reserves into gold, family offices building 15% positions in physical silver, the available supply cannot absorb that demand without substantial price adjustment. The mathematics are straightforward. Global investable assets exceed $400 trillion. A 2% allocation to precious metals would represent $8 trillion in demand. Total above-ground gold supply is worth roughly $15 trillion at current prices. Annual production adds maybe $250 billion. Silver's total above-ground investment supply is perhaps $50 billion, with annual production around $15 billion. The asymmetry is extreme. Small percentage shifts in allocation create disproportionate price impacts because the metals markets are tiny relative to global capital pools. And those percentage shifts aren't hypothetical. They're already occurring in observable central bank behavior and institutional positioning. This isn't about timing the perfect entry. It's about recognizing that certain environments favor certain assets, and the current environment structurally favors hard monetary alternatives to depreciating currency. The risks are real and should be acknowledged clearly. Volatility will be substantial. Drawdowns will test conviction. Policy could reverse, though the political and fiscal constraints make genuine reversal increasingly difficult. Markets could remain irrational longer than individual capital preservation timelines allow, but the alternative risk, holding purely financial assets denominated in deliberately debased currency during a monetary regime shift, carries its own significant danger. Position sizing matters enormously. This isn't binary. It's not all in or all out. It's calibrated exposure based on individual circumstances, risk tolerance, and time horizon. For some, that might mean 5% of liquid assets. For others, 20%. The specific allocation is less important than the recognition that zero exposure during this particular moment carries opportunity costs that may prove irreversible. Physical metal provides no counterparty risk, but requires storage and security consideration. Mining equities offer leverage to metal prices, but introduce operational and geopolitical risk. ETFs provide liquidity, but reintroduce counterparty exposure. Each vehicle serves different objectives. The sophisticated approach combines elements based on specific goals. What's critical is understanding that this isn't speculation on price movement. It's strategic positioning for monetary instability that's already unfolding in real time, driven by explicit policy choices with predictable consequences. The window is open now. It won't remain open indefinitely. And when it closes, when the dollar breaks key support, when physical shortages become headlines, when institutional allocation shifts from possibility to reality, the entry points available today will look, in retrospect, extraordinarily compelling, not because of certainty, but because of asymmetry. The cost of being early is temporary opportunity cost and potential volatility. The cost of being late is permanent capital impairment during monetary transition. History doesn't repeat, but the patterns rhyme with precision. And right now, the rhythm is unmistakable.